You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it. Picture this. Silver, a precious metal currently trapped in a bearish trend, suddenly catapults to a staggering $788. It sounds more like a fantasy than a financial forecast, doesn't it? But in the world of markets, what seems improbable today could turn into tomorrow's headline. In this video, we're peeling back the layers of the silver market, exploring the interplay of economic forces, investor sentiments, and technical setups. We're delving deep into the question, could silver really make this extraordinary leap? Stay with us as we unravel this captivating possibility and reveal how the unimaginable could become the inevitable. You won't want to miss the insights that could redefine your view of the silver market. So make sure to hit that subscribe button for more eye-opening financial analyses like this. Let's dive into the depths of the current silver market, where every fluctuation tells a story. At first glance, the situation seems grim. Silver has been consistently under pressure, with prices refreshing weekly lows and bearish traders seemingly holding the reins. But here's where it gets interesting. In the financial world, the present is just a snapshot, and every low is a prelude to a potential high. Consider the forces at play here. The market's bearish tilt is not just a reflection of current sentiments, but a complex interplay of technical setups and macroeconomic influences. You see, every low price, every dip, and every bearish trend holds within it the seeds of a future bull run. It's a cycle as inevitable as the ebb and flow of tides. Now let's peel back the layers a bit more. Despite the repeated failures to overcome the 100-day simple moving average, a classic bearish indicator, silver's story is far from over. We're looking at a market ripe for a reversal, where every rejection near the multi-month-old ascending trend line is not just a setback, but a setup for a comeback. And let's not forget the role of oscillators in this narrative. Oscillators on the daily chart, deeply entrenched in negative territory, are not just indicators of the current downtrend, but potential harbingers of an upcoming trend reversal. In the world of trading, what goes down often comes up, and these oscillators could be quietly signaling the beginning of a silver renaissance. Moreover, the market is always buzzing with speculations and predictions. The anticipation of further losses, the vulnerability below certain price points. All these create a narrative that most investors follow. But the savvy ones, they look beyond. They understand that in this narrative lies the opportunity for a dramatic shift, a shift that could propel silver to unprecedented heights. And this is just the beginning of our journey into the heart of the silver market. Remember to keep up with our in-depth analysis and not miss any crucial updates. Hit that subscribe button. Stay tuned as we continue to uncover the layers and delve deeper into the factors that could turn the tides for silver. As we navigate further into the silver market's labyrinth, it's crucial to understand the technical setup that's currently painting a bearish picture. But remember, in the financial world, what's evident on the surface often hides deeper, more dynamic undercurrents. The current technical setup, tilted towards bearish traders, might just be the prelude to an astonishing reversal story. Picture the scene: repeated failures to breach the 100-day simple moving average, a multi-month-old ascending trend line that's now a breakpoint. To the untrained eye, these are signs of weakness, but to the astute investor, they're potential springboards for a rally. Why? Because market reversals often occur when least expected, emerging from the ashes of apparent defeat. Let's delve into the oscillators. Holding deep in the negative territory, far from the oversold zone, they're signaling a downtrend. But here's the twist. These very indicators, in their extremity, could be suggesting that the market is overstretched, poised for a rebound. It's a classic case of the market sentiment swinging too far in one direction, only to correct itself with equal vigor. Now think about the psychological aspects at play. The market is a melting pot of human emotions: fear, greed, hope, and despair. Each price movement is a reflection of collective psychology. The current bearish trend might be feeding the market's fear, but it's also setting the stage for a wave of optimism, a sudden surge in bullish sentiment that could ignite a rally. And let's not forget the role of institutional investors and large traders. They often move in mysterious ways, quietly accumulating positions during periods of low prices only to trigger a rally when least expected. Their actions, though subtle, can have a profound impact on market dynamics. With that in mind, let's take a look at what the world-renowned experts in the silver markets, Andy Schectman and Michael Oliver, have to say on the matter.
Remarkable when you look at it in that light. The public in this country is too obsessed with instant gratification, and that's not even fast enough. And, you know, over the last decade nearly, or yeah, I guess you could say roughly the last decade, where cryptocurrencies have shown us the power of rapid appreciation, where suppressed interest rates And really, when we talk about suppression, to me, it's all about interest rates, which have created an illusion of prosperity in this country for years, where suppressing interest rates and then throwing massive amounts of money over the last few years, which we'll talk about in a moment, has created distortions in asset prices. They don't behave the way they have over the last several years. My mentor, Richard Russell, used to say, if you make 7% per year, you are a rock star. Well, the S&P 500 since the beginning of the century has averaged 7% per year, though I guess if you've been in an index fund just sitting there in the S&P, you are performing like a rock star. But lo and behold, the tortoise in this race, gold, has produced a 7.8% return, annual return, since the beginning of the century. And when you add into it, Dunnigan, the central bank and commercial bank suppression of the market, when you add into it the massive amount of money creation over the last several years, the Western market monetary expansion, massive. I think gold is well below where it should be, yet it continues to hold its own from a standpoint of value appreciation. And, you know, if you look at, for example, in 2020, gold was $17.73 an ounce average price. In 2021, that number was $17.98. In 2022, that number was $18.01. And in 2023, that number is $19.43. We continue to see it holding its own. And those numbers right there, you know, especially the last two, where it goes from 1801 to 1943 in 2022 and 2023 as an average price, comes in what is thought to be the worst environment for gold as of rising real interest rates. And so it held its own, very, 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 very much held its own. And, you know, when you look at it from the perspective that Rick Rule always talks about, that 0.5% allocation in this country owns any metal, and he's talking on a broad spectrum from the Harvard Endowment Fund to Joe Sixpack, as he always says, the fact that it has held its own and quietly appreciated, even in the face of rising interest rates, what happens when we pivot and go the other way? Another proxy to look for, I think, when we talk about, or to look at when we talk about just the kind of investment demand that could really propel things higher, is when we take the market capitalization of the S&P 500, all the market capitalization, and compare it to the market capitalization of GLD and IAU, the big Western ETFs. The market capitalization of the S&P 500 of the S&P 500 companies total is about $4.261 trillion. I think I'm right on that. It's about right. Think. The way that I wrote it down was 42,616 billion. So would that be, I think that would be 4,261.6 trillion. Anyways, point of it is that when you compare that to the market capitalization of GLD and IAU, which has a cap of 85 billion, that works out to 0.02%. So whether you're talking 0.5% of people owning it, or look at the capitalization of all the gold ETFs versus the S&P 500. In any respect, they are for all intent and purposes effectively zero. And so if the public wakes up and shifts just a few tenths of 1% of their allocation that was going into bonds, into precious metals, or into equities that were going into precious metals, it will, I think, you create a massive breakout in the price of gold in terms of its investment demand. But look, one of the things that I get pushback on when talking about the BRICS and their attempts to make a settlement currency, which is not the same thing as a reserve currency, is that, well, how could anyone ever, where could a reserve currency ever come from where the bond market would inspire the confidence the way the United States bond market has, which for years has been the most liquid and safe, stable market? Well, I mean, the first pushback would be after 45 years in 2023, the 10-year Treasury had greater volatility than the price of gold. Why? Because I think a good portion of the world sees what we just talked about. Little growth every single year with great liquidity. Well, isn't that supposedly what the bond market is? And from a historical context, holding government's debt as an asset, it has a very short history in a broader perspective. And especially a government that is going to be issuing $1 trillion in treasury bonds every single quarter, a government that is choosing inflation over austerity, a government who has let rates rise 11 straight times, destroying the value of those bonds in circulation, and now is talking about going the other way. This volatility, the mismanagement of the world reserve currency, the way that we have squandered our image on the stage, the world stage. We talk about this.
It'll help accentuate the Fed's desire to cut rates once they see the paper asset bubble rolling over again. They're probably pretty happy right now that the paper assets are hanging in there. Now, what really spooked the Fed, though, in our view, and we said this in about middle of last year before the T-bond market crashed, and that's what it did from like July, August, September, October, meaning yields rose, T-bond prices collapsed. We thought that would spook the Fed. That's one asset that they don't want to see get out of control, become illiquid, go the wrong way. And it certainly wasn't, quote, incremental. You know, they like to do things incrementally, you know, like they're scientists or something. Well, their T-bond market crashed on them. So that says you're not in control of anything. You know, Bruce Willis up in the building, you know, you're not in control of it. I won't say it, but anyway. So I think that's what really spooked them, more than any data point we might want to discuss on financial TV about, you know, 1 decimal point difference here or there. It's the collapse in their T-bond market that put a chill up their backbone and definitely caused them to, behind the scenes, decide, no more rate rises. And we'll put the hint out that we're going to cut too. It's not so much the data points, it's the collapse in that market. Now, since then, what we call the nuke event, before it happened, we also said it would be a V-bottom low, meaning you would get high yields, low price in T-bonds, but when it turned, it would come up like a V-bottom, like some collapsing commodity that finally went too far, you know what I mean? And it did, and I suspect the Fed and the Treasury are in there buying that stuff, along with some large asset managers as well. And this time justifiably so, because technically anyway, there was justification for a good counter-trend rally in the T-bonds or drop in yields. And I think we're going to see more of that over the next, let's say, quarter. We're not long-term bullish on bonds, but we do think rates will probably not be a threat and will be a so-called beneficiary to the stock market. The problem is it isn't. Historically, when rates come down, it's because the Fed is what? Concerned about something. And I think there'll be multiple things for them to be concerned about. So anyway, I don't trust the stock market rally here. Our technicals don't trust it. Price has nipped out the high, not on the S&P yet. But you've got to remember that especially the NASDAQ 100 and the S&P 500 are very heavily weighted up front with a handful of symbols. It's not 500 S&P stocks, it's like 5. Explain the entire move. In the NASDAQ 100, it's like 3 or 4 or 5 stocks, explain 50% of its movement. So keep that in mind. So the picture you see on an S&P chart on NASDAQ is not the true picture.
In our next segment, we'll explore how external economic factors like the upcoming CPI report and Fed policy shifts are adding layers to this intriguing narrative. Remember, the silver market is not just about numbers and charts. It's a story of human behavior, economic forces, and unexpected twists. So if you're intrigued by this unfolding drama, make sure to subscribe to our channel for more deep dives into the world of finance. As we continue our journey through the complex world of silver trading, it's time to shift our focus to the broader economic landscape that could play a pivotal role in silver's potential bull run. The upcoming U.S. Consumer Price Index, CPI report, and Federal Reserve policy shifts are like pieces of a larger puzzle, each influencing silver's trajectory in its own way. First, let's talk about the CPI report. This isn't just a set of numbers, it's a beacon that guides market sentiment. Expected to show a modest increase in headline inflation, this report could be the key to unlocking silver's bullish potential. How? Inflation impacts the value of currencies, and as the dollar fluctuates, so does the attractiveness of silver as an investment. A higher than expected inflation rate could weaken the dollar, making silver a more appealing safe haven asset. But there's more. The strength of the dollar and treasury yields are also major players in this drama. The dollar index rise and the surge in treasury yields are currently putting pressure on silver. However, these factors are part of a dynamic system, always in flux. A reversal of the dollar's strength or a dip in yields could change the game for silver, setting the stage for a rally. Now let's consider the Federal Reserve's role. The market is currently leaning towards expectations of an interest rate cut. Why does this matter for silver? Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, potentially boosting its allure. If the Fed signals a rate cut, we could see a surge in silver investments. Here's where it gets even more intriguing. Market expectations and investor sentiment often have a self-fulfilling prophecy effect. If investors start to believe in a silver bull run, their actions alone could help propel prices upwards. It's a psychological domino effect. Expectations influence behavior, which in turn impacts the market. In our next segment, we'll dive deeper into how these macroeconomic factors intertwine with market psychology, setting the stage for what could be one of the most unexpected turnarounds in silver's history. So don't forget to hit that subscribe button to stay updated with our comprehensive analysis. Remember, understanding the market requires more than just numbers. It's about interpreting the stories behind them. Continuing our in-depth exploration of the silver market's potential transformation, it's time to delve into the realm of investor sentiment and market predictions. These elements are often the silent drivers behind the scenes, shaping the future of market trends, sometimes in the most unexpected ways. Investor sentiment, a complex tapestry woven from expectations, rumors, and market signals, plays a critical role in determining the direction of silver prices. Think of it as the market's pulse, constantly fluctuating with every piece of news, every economic report, and every global event. Currently, the sentiment may be cautious, reflective of the bearish trends we've seen. But remember, sentiment is fluid, and a single significant event or a series of smaller positive cues can shift it rapidly from caution to optimism. Let's also consider market predictions and speculations. The current 66% probability of a U.S. interest rate cut in March, as indicated by the CME FedWatch tool, is more than just a statistic. It's a powerful indicator of where the market thinks we're heading. A rate cut could be a game changer for silver. Why? Because lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, potentially making it a more attractive investment. Now blend the anticipation surrounding the CPI report. This isn't just about numbers, it's about how these numbers could influence the Federal Reserve's rate decisions. A softer inflation report could signal lower interest rates, enhancing silver's appeal. It's all interconnected: the CPI report, Fed policy, interest rates, and silver prices. But let's not forget about you, the viewers and investors. Your perceptions and actions are part of this story too. How you interpret and react to these economic indicators can contribute to market movements. This is why we encourage engaging discussions in the comments section. Your insights and opinions are a vital part of this narrative. And while you're sharing your thoughts, remember to hit that subscribe button. You won't want to miss our next segment, where we'll tie all these threads together, examining how economic indicators, market psychology, and investor actions could converge to potentially fuel a historic bull run in silver. Remember, in the world of finance, every voice counts and every perspective adds depth to our understanding. Stay tuned as we continue unraveling this fascinating story step by step, leading up to the climactic possibility of silver reaching the astonishing mark of $788. As we approach the climax of our silver saga, it's time to focus on the critical junction where economic indicators, investor sentiment, and market dynamics intersect. This is where the true potential for silver's meteoric rise to $788 lies hidden, waiting to be unraveled. Consider the economic indicators we've discussed: the U.S. Consumer Price Index CPI report, the strength of the dollar, and the Federal Reserve's interest rate policies. Each of these factors is like a cog in a vast financial machine. Individually, they're important, but together it can set off a chain reaction. A softer than expected CPI report, for instance, could signal a shift in the Fed's approach, potentially leading to a rate cut. Such a move would not only impact the dollar's strength, but also alter the perceived value of silver. But there's more to this story. The interconnectedness of these indicators creates a complex web of potential outcomes. A weakening dollar in response to changing Fed policies could make silver a more attractive investment as a hedge against currency devaluation. Simultaneously, lower interest rates could reduce the opportunity cost of holding non-yielding assets like silver, further boosting its allure. Now blend this with investor sentiment. The market is a reflection of collective psychology, a fluid and ever-changing landscape of perceptions and reactions. A shift in sentiment spurred by favorable economic indicators could trigger a wave of bullish behavior. Investors, sensing an opportunity, might start moving towards silver, creating a self-reinforcing cycle of increasing demand and rising prices. And let's not forget the role of institutional investors and large traders. These market giants, with their significant buying power, can be the catalysts for major market movements. If they start to shift their focus towards silver, Based on their interpretation of economic indicators and market sentiment, their actions alone could drive up prices, adding fuel to the fire of the bull run. In our next and final segment, the Apex, we'll bring all these elements together, painting a comprehensive picture of how silver could realistically reach the astonishing price of $788. It's a scenario that stretches the imagination, but in the world of finance, the line between the improbable and the possible is often thinner than it appears. We've arrived at the apex of our journey, the crucial moment where we piece together the intricate puzzle of the silver market. Here, we'll explore how all the factors we discussed could converge to potentially catapult silver to an astonishing $788. It's a bold prediction, but in the realm of finance, bold is where the extraordinary happens. Let's start by synthesizing our analysis. The economic indicators, a potentially softer CPI report, the fluctuations of the dollar, and the looming possibility of a Fed rate cut are like a set of dominoes. A shift in one can trigger a cascade of changes across the market. In such a scenario, silver, traditionally seen as a safe haven and a hedge against inflation, could emerge as a star player. Imagine the scenario. The CPI report indicates softer inflation, leading to a weakening dollar. Investors, always on the lookout for value, might see this as a sign to pivot towards precious metals. Silver, with its dual allure as both an industrial metal and a monetary asset, becomes increasingly attractive. As the dollar weakens, silver's appeal strengthens. Now factor in the potential for a Fed rate cut. This could decrease the opportunity cost of holding non-yielding assets like silver. Investors, especially institutional ones, looking to diversify their portfolios, might increase their silver holdings, further driving up demand. But there's more. The market is not just about economics, it's about perception, sentiment, and momentum. As investors begin to see silver's potential, a psychological shift could occur. What was once a bearish outlook could transform into a bullish frenzy. This shift in sentiment, fueled by economic indicators and market momentum, could create a self-fulfilling prophecy, pushing silver prices higher and higher. In such a dynamic market, the impossible can become possible. The journey from current prices to $788 might seem like a fantasy today, but with the right confluence of economic conditions, investor sentiment, and market dynamics, it could become a reality. Remember, while this analysis presents a compelling scenario, it's crucial to approach it with a balanced perspective. This isn't financial advice, but an exploration of possibilities in the ever-changing world of finance. Always conduct your own research and consult with financial experts before making investment decisions. And there you have it, the culmination of our deep dive into the silver market's potential for an unprecedented bull run. If you found this analysis insightful, don't forget to subscribe for more thought-provoking financial content. Join us as we continue to explore the fascinating world of finance where the only constant is change.